I have the distinct pleasure of taking the business changes that have been so eloquently explained by my colleagues and trying to tie them together with some key individual changes, and raise some questions and some thoughts that we all will need to go through to determine which way we need to proceed with all these changes. This certainly brings to mind an observation that I have been making for decades in this practice, that preparing business returns in some ways are easier than preparing individual returns. And the reason I say that is, at least in business returns, we are presenting an income statement, meaning taxable income, the balance sheet, a reconciliation between book income and taxable income, and all those three schedules need to tie together nicely, and we have comfort that things are all accounted for and presented correctly. We don't have that benefit in preparing individual or trust returns. Having said that, the business changes that an owner-operated business or somebody with an interest in a flow-through business must account for are bonus depreciation changes, which were discussed already, the interest expense limitations that were discussed. The one thing I would point out in the interest expense limitation change area is Mike Klein mentioned that there is an election in 2020 for partners to be able to deduct 50% of the previously limited business interest. Keep in mind that that will normally be an individual's decision. The excess business loss suspension, which was not dealt with in detail today, was a provision of the TCJA that limited an individual's ability to deduct business losses to $250,000 per person per year, meaning on a married filing joint return, business losses in excess of $500,000 were not deductible. The CARES Act temporarily suspended those rules, and will give an opportunity in years 2018, 2019 to be able to fully deduct losses that may have previously been suspended on returns that were filed. The net operating losses, which were discussed in detail, where we have gone from no carryback period to a 5-year carryback period, would have two potential impacts on individual returns. The obvious one is when entities amend their tax returns to take advantage of some newly created deductions. Amended K-1s may create net operating losses for individuals. But in addition, if an individual has business interests directly on their tax return because they are sole proprietors, these business tax law changes may directly impact an individual's income tax balance. The individual only changes quickly are if you have a COVID-19 based defined contribution plan distribution, meaning if you or a direct family member were impacted by COVID this year, or were impacted through a significant economic impact of the coronavirus pandemic, you have the ability to take a $100,000 distribution from your defined contribution plan without incurring any tax penalties. And these distributions would be taxed over a 3-year period of time. You do have the option, if you take those distributions, even though they will be taxed over a 3-year period of time, over a period that begins on the day you took the distribution, you have 3 years to repay those distributions to your plan and have the amount be non-taxable. Required minimum distributions, while on their face these changes are relatively simple, also require some thought that we will get to in a minute. But what the rule presents is that if an individual is required to take a minimum distribution from a defined contribution plan in 2020, they have the option to elect not to take the distribution. Similarly, charitable distribution rules have been changed and liberalized for both non-itemizers, allowing a $300 deduction, or for itemizers increasing the adjusted gross income limitation from 60% of adjusted gross income to 100%. Taking all this and trying to put it together, the things we need to talk about, and Allison touched on some of them, is if you have a net operating loss at the individual level, first thing you need to take a look at is looking back over 5 years. What tax rate were you in those prior years? Were you subject to regular tax rate of 39.6% or the alternative minimum tax rate of 20%? That becomes a key determination in whether a net operating loss would be more beneficial with cash in your pocket now, or maybe more valuable as we look to move forward with a top tax rate of 36%. Once you get past that first hurdle with net operating losses, we may see that if you carry back a net operating loss 5 years, if you've reduced your 5th year back taxable income to 0, if in that year there were credits that were used, such as foreign tax credits, those foreign tax credits are freed up, which can further result in additional carrybacks. Lastly, in the net operating loss or significantly reduced taxable income year, if you don't have a carryback or the carryback is not worth significant funds, maybe the issue would be to leave the net operating loss or reduced income in 2020 and consider, instead of waiving an RMD, a required minimum distribution, consider maybe taking a larger distribution in 2020 to take advantage of the lower tax rate that you would be in because of these amended returns. Trust issues are all almost identical to the issues that I discussed for 1040s, with the further complication that to the extent that a trust has a net operating loss, if the trust chooses to carry this net operating loss back, it may either result in a refund of trust taxes or require issuing amended trust K-1s to beneficiaries, which would then trigger the carryback issues or amendment issues that I described for the individual directly, trigger them again because of an individual's interest as the beneficiary in a trust.